Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 14th, 2019. As we head into the final few hours of trading, it is about 1 o'clock Eastern Time right now. I wanted to do a video, and there's really, ironically, there's nothing new to report today. It's as I'm speaking, at least the markets are almost exactly flat. Yep, S&P just ticked down to 0.00%. And QQQ's right there with it, flat, and IWM's down. So now what I wanted to talk about is just a couple things real quick, kind of review the charts and talk a little bit about trading and swing trading in general. Now, kind of what prompted this video, I had a question put to me today. Good question. A member of the site had recently been long, at least TQQQ, the 3-time long ETF, and maybe the semis as well, and asked, hey Randy, is there enough meat on the bone to reverse those and go short today? And so my reply to that was, no. I think that what the bigger question isn't, is there enough meat on the bone as far as downside potential? I mean, that's still certainly there if the trades pan out, but more so, would I take the trade today? And I can tell you no. But there's two parts to that question. I continue to say I wouldn't take it today based on what's happened this week, and that. As you guys know, I've been watching the charts, really focusing largely on the weekly charts, and this is not ideal scenario. In fact, it's the opposite of what you want to see following those weekly bearish engulfing candlesticks that we had on the indexes last week. You wanted to see red follow through. Now, the week isn't over, but it would take one heck of a fade now to have a follow through red candle this week. So I can say this emphatically that if I were not short QQQ and the semis, then I would not short them today because of that. However, on the flip side, I also have absolutely zero intention or desire to modify the existing trading plan on those shorts. So in other words, the two are mutually exclusive. Just because I wouldn't short it doesn't mean that I feel I should cover those shorts, because nothing compelling has changed in the charts since they were entered. Now again, we didn't have that confirmation that I was hoping to see and expecting to get on the index ETFs, but however, on the flip side, they're roughly where they were entered last week. I'll get to stocks in a second, but more importantly, the bigger picture is this. So basically, if you look at it this way, the QQQ is our play on the. Oops, hit pause there. Even though it's of course it's here we go. Sorry, I was messing around with my drawing tools and I had to get the right tools. So what was I saying there? I paused it for a second. Yeah, either way, they are those two are mutually exclusive. One doesn't always have anything to do with the other. Now, had I seen something very compelling to urge me to close out the shorts, absolutely. I have no problem modifying a trading plan if there's something compelling. But if you look at it this way, the basis for those short trades last week, before we even had the weeklies, remember, those were put on, we had daily bearish engulfing candles on the daily, and those were confirmed. So we entered SOX on that day, then we followed through on QQQ, was it the following day or right after that? So the basis, I believe, was solid for those trades. And at this point in time, we haven't taken out those bearish engulfings from last week, at least. And again, I'm looking at the broad market here, and I'm looking at a lot of sectors. I'm taking the market as a whole, not just QQQ, although that's I'm going to get to that in a minute. That's just been strength led by single-handedly tech stocks carrying the Qs above everything else this week. So that's that, and again, I just wanted to mention that that one really doesn't have much to do with the other. It could, again, if we had seen or continue to see some very bullish price action here, but so far, and let's just look at the SOX here. So there's the SOX. When were we last? There's last Monday's candle. Although we didn't have a bearish engulfing there, we also had, we had it on the broad markets, and the SOX had failed. It continued to fail at this downtrend line. So that was the basis for the SOX trade, which, by the way, is a semiconductor ETF. So you can see nice downtrend line, and sometimes you can have a sector fall, and quite often that you do have a sector fall when the rest of the market's going up. So this trade on itself, based on the reasons it was entered, still looks fine at this point in time. It just continues to fail here. It's had several failed attempts to pop up and hold above that primary downtrend line. It's also broken below this uptrend line here. And so like the broad markets, it's not going down, but it's not going up, at least not for the past. If I grab where today is and I go to the left and I can come to, we're trading at the same levels we were now, 21, 22, almost, yeah, here it is. Where was I? Just right here. Yeah, 3 weeks ago, over 3 weeks ago. So yeah, we've gone up a little in that 3 weeks and we've gone down even more, and we're back to where we started. So again, is that ideal bearish price action? Do you want to see a trade go underwater? Of course not, but it is not enough, in my opinion, to modify that trading plan. Here's the chart on the stocks, the 60-minute chart. There was that divergent high back here. It was Monday the 25th, and so far we're still below that high right now. And if we happen to pop it, let's say today or tomorrow, equal or move above it, as long as they don't stop us out, I'm fine with that. We're just going to put in an even larger divergent high, and that in itself, by the way, doesn't guarantee the trade will play out. It does set the stage for an even larger drop. Bigger divergences, typically bigger drop. And same story with QQQ. It's a busy chart, but this is the one I'm using with the price targets, and you can see the divergence line. So we had divergence last week after we added that short. It's gone underwater by a little bit, and we're talking a couple percentage points. And again, I've talked on that, and I put up the trading calculator, position size calculator on the home page. If anyone that is underwater, and I do know, I will acknowledge we had a couple other trades that were stopped out, but for also relatively small. We're talking maybe 3%. Stop losses on those. But again, if you're in a trade and a 2 or 3% loss is making you lose sleep at night, or the dollar losses are significant, then you're trading too heavy on your position size, and you should consider lighting that up. Or again, the old adage on Wall Street: sell down to the point at which you can sleep at night. So there's QQQ, and again, I just wanted to make mention that taken collectively, I don't see a lot of or enough evidence right now to modify the existing trading plans on the few shorts that we do have. And if they stop us out, then so be it. That's what stops are there for. The other thing to that is I just want to mention, kind of on a related note, about whether to trade, not to trade, whether I'd take a short right here or not, is the old thing, I call it ABT, always be trading. There's an urge, we call it traderitis. I'll refer to the urge to ABT, always be trading, and that is to always be in a trade. For example, to the member that just closed out some longs, great. And would you short now? I gave my opinion, and obviously he was long, he or she, before when I was still short last week, so that's good, and I'm glad to see that. This site is not a follow me site. It's just here's some setups, here's objective, here's some things I see. I'll give you my opinion if I have one where I think something is going, and some of those will play out and some won't. But most importantly, take your own trades, and one reason this isn't a follow me site, it's not a diversified portfolio. Throw out when and this is where I'm leading into the next topic here. In swing trading, the whole point of swing trading, unlike buy and hold investing, it's to get in and get out when there's big moves. And I can tell you this now, and I can tell you this with certainty, that most of the gains in swing trading on a particular stock, if we're referring to the index, let's say we're trading the indexes or a particular commodity or a particular sector, most of the gains are made in very short periods of time, bursts. These are the micro trends. This is what swing traders are after, these kind of trends. This is what an investor or trend trader will get to over the years. But swing traders try to capture these rips and dips, and they, if you're very active, this is where an active swing trader can game these. We did have some, I was doing a lot of active analysis in here, reversing trades. However, let's say a longer term or typical swing trader that's not very active, or a trend trader, just gets chopped to pieces. And so you want to try to avoid in these kind of trends here. I mean, of course, that's a nice trend to capture, and that was an unprecedented low volatility trend. So this really isn't a great example right here. But these are the type of trends that we try to capture. And we're not going to get them all. Like I said, on the bottom here, was able to capture most of that and had a few shots on the shorts. But lately, here's the thing. It's been a sideways market for the last over a month now. And so again, that's when you want to kind of lighten things up. So I've maintained probably more emphatically than anything that the risk reward over the last few weeks was not favorable on the long side. And I said that doesn't guarantee the market can't go up, but I said it then and I still maintain it now that the upside potential compared to the downside, the risk of a downside sudden quick swoon down, it just doesn't warrant it. And some might believe it does, and maybe they'll be proved right. And like I said, I've laid out some levels to buy dips on pullbacks. And so it is entirely possible that this consolidation now was enough to work off the overbought conditions down here on the RSI. You can see we became overbought. And if it's in this market, if the economy is going to continue to, chug ahead, we've seen a lot of things rolling over, slowing down recently, but if those are just aberrations and things are going to pick back up, then I can tell you this would certainly help that case for the market to go on and break out to new highs now that we've had that pullback, reset the overbought conditions, worked off some of the bullish sentiment. So although possible, again, bigger picture here is we're still at and have been failing at this resistance level. And like I often say, resistance is resistance until and unless taken out. And you want to see it taken out with conviction. So that's it. And remember, I'm going to put trade ideas out. I'll try to do is when I see things, I'll put those charts I'm watching, updates out in the morning, and of course throughout the day in the trading room, because that's what I do. If I see something, I'll share the analysis. And you'll notice, official trade ideas continue to be very light, and that is just because the risk reward, and I don't think it's very, very conducive right now for swing trading. But there's some ideas that I figured looked compelling enough. We threw those out there, and I'll continue to add to that, and I'll continue to focus on other things besides the market. I'm doing a lot of talking about the broad markets here, but remember, if you draw, if your portfolio is a pie, this is the pie, you should have pieces of within that pie. In other words, you should have asset allocation, you should have some bonds, you should have some stocks. And I'm not holding these to, these aren't proportionate, but the stock market shouldn't be 100%. It can be. There are some swing traders that only focus on one or two securities. Day traders tend to do that most. If you're swing trading, at least in I think it makes sense to diversify and have different sectors. Like right now, we're focused on some ag commodities, gold. That's another one. It's another good point that I was reinforces the point that I was just making, where I stand aside. We've traded gold. Throughout the years, I watch gold every day, and I know there's a lot of interest in gold in the mining stocks. And if you look at where we were long recently, I forget the entry, but as official trades, we're long from here to here somewhere. So we caught the bulk of that move, and I get a lot of requests for updates if I don't post them every few days, and then I'm glad to answer those. But my thing was to step aside. And kind of watch and let the dust settle and go, let this divergent high play out. That trend line break happened, but I still, to me, this is just I don't have a strong read on the near-term direction. I've given you recently where I figured would be a good level for long-term investors or traders to scale in, scale down on gold if it gets there, especially if it comes all the way back down here. But as far as swing trading goes, this is what I attempt to avoid. This is what I attempt to avoid. And I attempt to capture this and this and this. That's my goal. Because if you look at it this way, okay, even if gold went sideways here, well, it did drop after that out of the range, but if you were long there, even if you got out the end, it's dead money. It's tying up money. Unless you have unlimited amount of capital to invest with, I don't want to be stuck in a trade that goes sideways for 6 months, tying up capital, especially in something like gold that doesn't pay out a dividend. So I wanted to kind of share that as well, and that's speaks to the fact that the official trade ideas are light. But again, I'm going to post what I see. Doesn't mean you need to take it. Take what you're comfortable with, and especially if it aligns with your own analysis. Like, again, I know there's people that really are hyper focused on gold. I've seen that over the years. Same members asking updates on gold and GDX, and like I said, I do my best also if I have a good read on something to tell you, and if I don't have a good read. And gold right now, like I said, longer term still looks good to me. Near term, this is what you've been getting lately, and this is why I haven't been in that trade. I took a shot here, started scaling in some long-term accounts, and I'll continue to hold that, and I'll continue to scale down here. But I really don't want to see it go much below that 120-ish level on GLD. And again, that's long-term stuff. That's not swing trading stuff. I'm just starting to scale back into some long-term positions in gold. And that's about it. I didn't want to do a whole comprehensive update, but I did add this wheat. I've been watching wheat, and like I told you, corn, they tend to move together very often. Not always, but usually. So if I add corn later, keep that in mind with your position sizing, that if you have let's say you wanted to allocate, you had 100 grand and you wanted to put 20 grand into agricultural commodities, and let's say you just took, 20,000 in wheat. If you decide to take corn later, well, ideally you want to reduce that wheat position. Otherwise, corn and wheat together will give you a high concentration. A lot like I did the other day. I highlighted the very strong correlation, the unmistakable correlation between crude oil and the stock market. So again, if you're long or short USO and you're long or short SPY, you have virtually zero diversification right now. They can disconnect. At times they do, but as of lately, they're going up in almost lockstep. They're moving up and down. So you need to kind of be aware of really, the nature of the securities that you're trading when it comes to that whole asset allocation, dividing up the pieces of the pie within your portfolio. And here's a quick update on Joe. Coffee looked like it was starting to perk up today. But so far, it's kind of same story. It's basing here. We're still above our stop. We haven't hit our first target, but I do like what I see. This is another one where, on this I could tell you I'd probably be a little more apt to initiate or maybe add to a position if I was planning to do so before, than I would be to short the markets right now, because this one, again, this trade was all based on coffee falling to long-term support. We're not looking at it here on the 60-minute chart. This is just trying to hone down our entry and exit. So it hasn't really popped yet. Looked like it was getting going, but it also is holding that long-term support, which as I just said a second ago on the stock market, resistance is resistance until and unless taken out. Same thing holds true on a security with support. Support is support until and unless taken out. So coffee continues to test long-term support here. So when you're looking, this trade was based largely off that 20, what was it? I forget how far back we went, but it was a long-term, I think, weekly chart. At least support going back for several years. So you have to be a little patient for that sometimes to play out on the 60-minute chart. And then most importantly, at the end of the day, patience is one thing, but you also don't want to become married to it, and that's what stops are for. So if they take the stop, so be it. They can have my Joe. And if they hit the targets, like I said, I may extend targets because this one, just like wheat and corn, has the potential to be much, much longer and more profitable bottoming plays here. And I can even tell you this: if Joe and wheat and corn, but mostly Joe here, if it hits my second target right here on the swing trade, if it does that, it will have walked away and done some things, put in some bullish technicals on those longer term charts that will sharply increase the odds of a lot more upside. So that's how that works as well. So this is kind of contingent. It's almost an all or none thing. So in other words, we either hit my swing targets, in which case before we'll hit there, I'll extend the targets on this, or it doesn't pan out. Coffee does not hold that long-term support and continues lower. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.